Zynga pricing its long-awaited IPO tonight. My next guest is here to discuss that development and also the current IPO market. He is Fred Lane, the Vice Chairman of Investment Banking at Raymond James, and of course David Kelly staying with us through the hour from JP Morgan Funds. So let me first get your take on the Michael Kors IPO. Oversubscribed, pricing at $20 a share. What does that tell you?
Well, it tells me that special companies get special valuations and special interest, and I think Michael Kors is a very significant player. This is again emblematic of what's going on in the IPO market. The big, successful, proven business models, or the big, exciting, high growth potential models are getting a lot of attention.
The ones that generate the media attention, essentially.
Well, and the fact that the IPO is of great size. You know, I think big market caps and large offering size provide institutional investors reasons to do the research, make the commitment to jump in, because structurally they can do that. If you've got a $4 billion fund, you can't buy $4 million in an IPO. It just doesn't work. And that's typically what happens in the $100 million IPO space. So that's why we see so many, this IPO market's dominated by large transactions.
Right, and we always hear constantly, and I know, David, we've talked about this as well, is that Facebook could list at any point. It doesn't matter where the markets are, because Facebook is such an extraordinary company. So you can't read too much into some of these IPOs, right?
Well, no, but that's true. In terms of the pricing, it's very difficult to figure out what the correct pricing is, particularly for a very well-known brand. But I think it does speak to the hunger that investors have for good ideas. I mean, a lot of the fixed income is very unrewarding. People are pretty negative, very negative on stocks in general. So a lot of institutional managers are looking for niches, ways of playing the market that they can get some extra return without committing themselves to these big asset classes.
Well, Fred, are investors more discerning? Are they more careful when they're looking at these IPOs these days?
Well, I think the market has demanded that, because I think the volatility in the market, and particularly smaller companies, have more fragile quarterly results. So it's a very dangerous place to be playing in these small illiquid positions. So I agree with what Mark just said. I mean, the fact of the matter is that there's really a strong preference for companies of real size and substance. And Michael Kors certainly fits that category. Zynga fits that category. And it's been really interesting to watch the debates back and forth. There's a real passion about, is Zynga a good company? Is it going to be overvalued or not? And I think that's reflective of the interest in institutional investors in actually taking positions in these stocks.
And how do you even value Zynga, right? I mean, that's been a question for Zynga, but also for Groupon.
Well, and I think one of the problems is for technology that technology changes so fast. So, that what was the hottest thing 3 years ago doesn't seem quite so hot right now. And so, you think about cash flows over a long period of time, but it's very hard, even if you've got dramatic growth and a very well-run company, it's very hard to look 5, 10, 15 years down the line in terms of cash flows. And I think that does make the pricing of this very challenging.
I think Zynga is a little different story, because Zynga has significant revenues, and it also has significant earnings.
Right.
It's also true that the business model is a little confounding, because 3% of its customers account for virtually all its revenues, but the customer base cuts across generations. There are people in their 60s and 70s and 80s who play Farmville, and there are lots of teenagers who also play Farmville and Cityville, and it's confounding to someone like me who says people pay real money to buy virtual pigs or tractors or whatever they do. It's amazing.
It's astounding, isn't it?
It's astounding, and yet is it any different from going to the casino and you putting money in your slot machine? Not really. And people are captured by this. And I think the real bottom line here is that this is a content play, and it's a unique delivery play, right? This is another example of the power of the internet, delivering games, interactive games, and it has a social media aspect, which we can all talk about, and you kind of add it all up. But it is a hits business, and so I think the key here is, do they have the creative capabilities to continue to come out with new titles to drive growth?
That's so important, is that you've got to have great management. If you look at the really successful technology companies over the last 2 decades, the reason they're successful is because they can actually evolve over time into different kinds of companies, because their managers are smart enough and far-seeing enough to realize that the environment is changing around them and they have to lead in other ways.
But it sounds like, because these companies need to still grow into their potential, and I was talking to Dixon Dahl about this as well, these stocks are going to be quite volatile, don't you think? Maybe perhaps even more so than other technology companies?
I'm not sure I agree with that. I mean, if you look at Zynga, there's a company doing basically a run rate of over $1 billion with very high operating margins in the 50% range. And these games have, there are 225 million people who go on each month and play Farmville. That's in 175 countries.
That's
I don't
huge,
know.
yeah.
It's pretty hard to
If it was all
figure that
here
one
in the
out.
US, it'd be everybody.
Yeah, so this thing has a lot of traction. So it's hard for me to believe that suddenly Farmville and Cityville are going to go completely out of fashion.
Right.
Now, I do think the bigger issue, and that's the issue mentioned earlier, is this issue of growth. Because there is a growth valuation inherent in it. I don't happen to think the valuation's crazy. Would I go in this stock up to my elbows and commit a large amount of money? I probably wouldn't. But I think this company really potentially has legs. But as was said,
yeah.
it's a management challenge here.
And of course, I mean, in this, as in everything, you've got to diversify. If you bet on a number of different technology companies, and you're not going to score home runs with all of them, but hopefully you get 1 or 2 home runs in the bunch.
Okay. David, thank you so much for being with us this hour. David Kelly of JP Morgan Funds, and also, of course, to Fred Lane of Raymond James. Thank you.